Welcome to myvelocitybanking.com channel where we save you money by showing you how to implement the Velocity Banking strategy. If you haven't already done so, head over to the website and sign up for a free account. Enter your information, including your income and your expenses, and it'll automatically calculate for you chunk payments, tools to actually use to make the chunk payments, and then give you a schedule of when these payments are actually due to help you pay down your debt faster. So today we're going to talk about balance transfers. We got an email from one of our users and he was confused about which balance transfer credit cards he should actually use. So we walked him through the best one for him given his scenario. So there's two credit cards that he was looking at. One was the Tangerine cashback credit card, which has no annual fees, obviously cashback rewards, but we looked at the fine print, which was down here. The balance transfer was 1.9%, 1.95% interest rate, and it was for 6 months. And then after that, the interest rate jumps to the regular interest rate. Also, there's a balance transfer fee of 3% of the total that you actually transfer. So those were the three things that popped out to us, stood out to us with the Tangerine credit card. The other credit card he was looking at was the MBNA card. And so the MBNA card, we really liked this one. So this MBNA card had like no interest, no annual fee, 12.99% regular rate, and a 0% interest for 10 months. And you had up to 90 days to actually transfer your balance into it. So this is what we really liked. So we advised him to go with this one, but it all depends on what your scenario is. So the balance transfer works like this. So there's four unbreakable rules when you're doing a balance transfer in conjunction with your Velocity banking strategy. So the balance transfer is a good way to use the bank's money for a limited period of time to pay off your other debt. So the balance transfer is basically this. You have a high interest rate credit card and you move some of the balance onto this low interest rate credit card or no interest rate for the promotional period. So once you do that, you can save on interest, so you're still making payments, but now the payments are less and it's got more impact. So the payment goes more towards principal than interest. So the whole goal of balance transfer is to let the bank kind of pay off your debt for you for this limited amount of time. Given that, there are four rules you need to keep in mind. Rule number one, never ever miss the minimum payment on your balance transfer credit card, because if you do, it automatically jumps to, you lose that promotional rate of 0% or 1.99% and automatically jumps the regular rate. So make sure you make those minimum payments. And if you do use the myvelocitybanking.com website, we break this down all for you as to when the payments are due so you never miss those payments. Rule number two, do not make any purchases on your balance transfer credit card, because they will be charged at the regular rate and you will not be able to use the promotional rate for any other purchases. So just keep this for the balance transfer only until that is paid off. Rule number three, very, very key as well. Do not transfer more than the credit limit of your card. So let's say you got a credit limit of $5,000 for the promotional rate of 0%, for example. And if you transfer 5,003 or 5,010 or whatever is over that credit limit, you lose that promotional rate and they charge you the regular rate for that balance. So very, very important. And so keep those three rules in mind and you will be able to take advantage of the balance transfer while you're doing Velocity banking. And of course, rule number four is that you have to keep in mind that this is just a limited time. So you have to keep an eye on the promotional period when it expires. So like we said before, some are 6 months, some are 3 months, some are 10 months. So keep track of when that promotional period expires and try to pay off as much debt as you can inside this period. And if you can do that, even if there's some left over and the rate jumps a little bit, that's not too bad because you've already cut down a lot of the debt in that promotional period. So keep an eye out on when that promotional period ends, just so you're prepared for it. So until next time, don't forget to subscribe and like our channel, and we will catch you next time.